Hey all, welcome to question 2 of the Tax 217 main exam. Now, this question appears to be around depreciating assets. We've got a list of assets within a company, for example, sofa, exercise bike, and so forth. So it's more equipment. And what the question's asking us to do is calculate the decline in value. So generally when we see decline in value, we know straight away to go to our notes and say, look at the chapter relating to capital allowances, which is Division 40, depreciating assets. So the other thing the question is asking us to do is calculate balancing adjustment, if any. Now, if you remember what a balancing adjustment is, it's effectively when you sell the asset. And similar to in a capital gain situation, when you have to figure out whether it's a capital gain or a capital loss, once you actually sell the asset, it's similar for capital allowances in that you actually have to, once you sell the asset, figure out if you're actually going to make a gain based on how much you're selling it for versus the cost base, which is the terminology for CGT. In this case, the terminology is the written down value. So if the consideration of selling the asset is greater than the written down value of the asset, you're going to have a balancing adjustment, and you need to include that in your assessable income. If you need to touch up on your capital allowances knowledge, we've got a video down below on capital allowances and just explaining that whole topic. Anyway, so let's dive into this question and see where the tricks and tips and tricks are. So if I was approaching this in the exam, the first step I would do is I'd actually bring up my critical file and bring up this chapter here, just so I've got it in front of me and handy. So let's work through the next questions. Okay, so the second thing I'd do is I actually set up my work paper to something like this, where you've got your list of assets, your calculation, decline in value, and balancing adjustment if it's applicable. I'll probably color these out if it's not applicable. So then next step is I'd actually work through each of the items in the list. So the first thing we've got is a leather sofa in reception. So I'm just going to type sofa for my first asset. Now the net book opening value at the 1st of July is $2,100. And the date of acquisition was at the beginning of this financial year. And keep in mind the financial year we're working with, because this is an older exam, is for the income is still applicable. So I recommend going back as far as you can with exams and just updating the legislation or the thresholds or whatever to the current year and still doing the questions. It's still good practice. So the financial year we're doing is 30 June 2017. So we know for this asset, they've held it for 2 years. This is the second year of holding it. So they bought it for $3,500 originally. Its useful life is 5 years. The question you're going to have, if you know the background around capital allowances, is there's two different types of declines in values, and depending on which one is the right one to use, is going to result in a different decline in value expense. So basically the two main methods are prime cost. The second is diminishing value. Now the first one, it's effectively you just do a straight line, divide by its number of effective life, and apportion it for any number of days in the year. Whereas diminishing value, you actually get a bit of an acceleration up at the beginning, and you times it by 200% basically. Now, depending on the type of asset, you might be compelled to use a certain type. So for example, if you're using a low value pool, you must use diminishing value, not prime cost, unless intangible. So there are some certain rules depending on the type of asset. So let's have a look in the question, see if they've specified anything in the notes. So it says down here, first note here, they've chosen to apply the diminishing value method to depreciate their leather sofa in the prior income year. Now we do know that if they've elected to use one type of method in the prior year, you also need to continue with that method in the current year. So let's fill out our workbook for this one using the diminishing value method. So the first thing we're going to do, if we bring up our notes, we'll see that calculation is base value times days held over 365. Now we've held it for the full year, so we don't need to do this bit, times 200% times the asset's effective life. So the base value is calculated in 2 steps. It's the cost exclusive amount plus any portion of GST that cannot be claimed as income tax credit. That's not applicable in this question because it's GST exclusive. The cost is the decline in value equals the opening adjustable value. So we're basically going to take the opening adjustable value and we're going to times it by 200%, divide by assets effective life. So the calculation we're going to use is the opening value is this 2,100. We're not going to use that cost value. We're going to use this one here, 2,100. We're going to times it by 200%, divide by 5. So let's do that now. 2,100 times 200% divided by 5. We're going to get 840. So that's a declining value. Now in the exam, what I'd do is I'd actually write this out. So what you'd see is this in your exam work paper. I'm not going to do it. I'm just going to type in the formula because I'm using Excel. But then you'd put your written answer there over there, just so the marker can quickly see, yep, okay, that's your workings on the left-hand side. That's your answer on the right-hand side. And there's no balancing adjustment because I haven't sold this asset, so I'm not going to put anything there. Okay, so moving on to the next one, the point of sale software for reception. So straight away, I'm seeing, okay, this is a computer software, point of sale software. There's usually some specific rules around software in terms of what we can actually, depreciate for. So that's the first watch out. So the note down the bottom is this software is commonly used in the fitness industry and was acquired by Heavenly Bodies. So the date of acquisition was in July 2016. Its net book, so at the beginning of this financial year, its cost is $5,500. Its accounting life is 4 years, and its net book opening value is $0. Okay, so ordinarily, if it wasn't software, what we would do is we'd just do a straight 5,500 divided by its accounting life, depending on which depreciation method we're going to use. But however, because it's software, we need to look into our notes. So we'd just be thinking software equals specific rules. So let's have a look at our notes now and see what the rules are around software. See up here in effective life that intangible assets, which includes software, must use prime cost methods. That's the first thing that we need to observe. Must use prime cost method. The second thing to observe is in-house software, which includes purchased off-the-shelf software or developed and used for purpose in which it was developed, which is applicable here because they purchased this off the shelf. It has an effective life of 5 years. So just because for accounting purposes, just because they said they've got an effective life of 4 years, doesn't mean that we use that number, right? It's the same as the last question where you've got your accounting or your financial, expenses and treatments, etc. That's great, but that doesn't necessarily apply for tax. That's why we have to make these adjustments for tax purposes, because whatever goes in tax is prescribed by the Income Tax Act. Okay, so what we're going to do is we're going to take the opening, well, if you need, we can have a quick look at the formula, but you should know this by now because it's fairly simple for prime cost. It's basically your assets cost. Note that's different from base value. It's what you paid for. Apportion it for the first year if you only bought it for part way through the year, and then do 1 over assets effective life. So what we're going to do is we're going to go point of sale software. We're going to go cost base, which is the 5,500, the cost. And we're not going to divide by 4, we're going to divide by 5 because that's what's prescribed in the Income Tax Act 1997. So we're going to go equals 5,500 times 100% divided by 5, not 4, we're going to use 5. So the answer we're going to use is 1,100, and in your exam paper, of course, you're going to put your workings out like that, so it's a bit more written out. There's no balancing adjustment because we haven't sold it. Okay, so the next one we're going to work through is the 3 exercise bikes old. So the note down the bottom is 3 of the exercise bikes had broken parts. It was cheaper to replace these bikes with new bikes of the same model than to replace the parts. The old bikes were sold on 1 July. So when I'm seeing something like this, so what's happened here is they've actually sold the bikes. See how it says here, the opening, so they've depreciated it down to 1,500, which they bought it, whatever it is, 4 or 5 years ago, 3 years ago, 4 years ago, based on this year's exam. So they're depreciating on a straight line basis for 3 to 4 years or whatever it was. It's now worth $1,500 at the written down value. They've now said it's cheaper to just replace them. So what they've done is they've sold them. They sold them for this $500, and they've just used that to purchase new bikes, which we'll talk about in the next question. But for this one, 3, what we actually have to do is what I mentioned before around the balancing adjustment. If you're going to sell a depreciating asset, you need to take the sales proceeds less the decline in value, and that gets you a balancing adjustment. Okay, so it's very similar to the capital gains / capital loss concept in the capital gains chapter. So what we're going to do for this one is we're going to calculate what the decline in value is going to be for the sale of old bikes. So there's no depreciation, but it's basically going to be your sale proceeds less your written down value. So it's going to be $1,500 minus your $500. It's going to be $1,000. But is it a gain or a loss? Because they sold it for $500 and the written down value is $1,500, that's effectively saying you're selling it for $1,000 less. So we're going to put it as a balancing adjustment of $1,000. Let's put it this way. And let's just clarify in the sign which way it's going to go. Minus $1,000 deduction, just so it's super clear whether it's an income assessable or deduction for exam people. And I'm going to grab this one because there's no decline in value for this one. Okay, so for the next one, 3 exercise bikes new. So again, they bought this at the beginning of this financial year. Let's see what the note says. So 3 new exercise bikes were acquired to replace the bikes sold in note 3. So the thing to consider whenever you're doing repairs and maintenance, okay, which includes replacements as well, is does this asset substantially replace the old one, or does it add substantial new features? So this is starting to get into the old expense versus capitalization argument, and there's a whole bunch of notes around this within this chapter, and again you can watch the video to kind of learn a bit more about it if you're not too sure. But there are certain rules around at what point do you capitalize something versus expense it. So if you need to catch up a little bit about this concept, remember back to chapter 3, I think it was, deductions. When you're talking about case law about whether something you actually can get a deduction for it, or if we need to capitalize it. Now, there's certain rules around whether it's deductible or not deductible. So number 1 is if it's not deductible, i.e. capitalized, it's improving the function significantly. It's an initial repair, replacement of an entire asset. So consider depreciating asset and claim capital allowance deduction here. So this is the relevant one that we're going to apply to this situation here, because what's happening here is they're not repairing the asset. If they're repairing the asset, it would be an expense. If it was a replacement of the entire asset, we would basically capitalize it. Okay, so that means we're going to be able to claim a deduction for these new exercise bikes, but only not the entire amount, which would be an R&M. It would only be, we'd have to do a decline in value calculation for this as well. So that's probably just to watch out to make sure, is it an R&M expense or is it a decline in value? So what depreciation method are we going to use now that we know? So it says down here, Heavenly Bodies also makes the choice, because it doesn't actually specify what method we're going to use. Heavenly Bodies also makes choices under the tax legislation to minimize its taxable income. So that gives you your first hint about which depreciation method we should be using. Because if it's not actually specified, you can choose which method you want to apply, and it's the first year as well. So let's go back to our capital works chapter. So they've got 2 options here, right, which we discussed before. You've got prime method and you've got diminishing returns. Oops, sorry, wrong chapter. Here we go. So we've got prime method, which is straight line, and we've got diminishing value. This entity has a choice between applying either of these methods. However, one of those methods results in a higher deduction up front than the other one. Do you know which one it is? It's this one here, diminishing value. Now, how that depreciation works is it applies the most in the first year, and then over time it slowly provides less and less and less. It's kind of like an inverse hyperbole, whereas straight line is more of a, you get the same amount every single year, no matter what it is. Now, because this is the first year of buying this asset, to minimize their taxable income, they'd actually have to apply this one, diminishing value, because they're going to get a 200%, or they're going to get basically double what they'd normally get in a straight line approach. But if it was the 5th year, they would get much less with this approach. But you do have to be consistent in the approach that you actually undertake. You can't switch from diminishing to straight line in year 5. It doesn't work like that. Okay, so let's put in our, so 3 new exercise bikes. The calculation under dimensioning value is going to be the cost, which was 6,600 over here. So it's going to be equals to 6,600 times by 200% divided by the effective life, which was 5, which is going to be 2640. Okay, and then we're going to show our workings as well. There we go. Okay, next part is floor covering in group fitness room. Okay, so for the next one, which is floor covering in group fitness room, there's a bit of background information here. So they've installed this in the fitness room to replace part of the old floor covering 40%. The old floor was damaged by stormwater. The new floor covering is made of artificial rubber of the same standard as the existing floor covering. The floor covering reduces the risk of injury during exercise and yoga class. Okay, again, this is going to come down to whether or not we can claim a deduction as a R&M expense, or is it going to be capitalized? And if it's capitalized, then we can actually apply our decline in value adjustment here. So we only need to calculate decline in value. We don't need to calculate R&M expense. But if it is going to be an R&M expense as opposed to a capitalization, then, well, we're not going to include any value here because we only want to know decline in value amount. That's what it says in the question. It says to calculate the decline in value and a balancing adjustment. It doesn't say calculate, taxable deduction. If it was calculate taxable deduction, well, then we will actually include the R&M expense in there as well. But it's only specified those two exact things, so we need to be very precise as well and follow the question exactly. The question is, does this constitute a replacement, or does it constitute, is it a capitalized or an expense? So to do that, we're going to go to our notes. We're going to go back to this deduction page, which I showed you a little bit before in terms of these charts over here. So in terms of what would constitute as a deduction or R&M deduction, it would be restore function, renew part of an asset, or does not change character. Whereas if it's not deductible, i.e. capitalized, it would be replacement of the entire asset, an improvement of the function, prevent future damage, or initial repair. So basically, in short, how I would summarize it, are you just replacing the same or repairing the same asset without improving functionality? Then it's an R&M expense. If it's replacing or improving the asset completely, then it's capitalized. Well, the first thing to notice is they're only replacing 40%. They're not replacing 100%. The second thing to notice is that it's the same standard as the existing floor coverings. We're not actually improving the functional character of this asset, which would indicate a capitalization. So right now we've got two factors leaning towards an expense, an R&M expense. So let's go with that, and we're going to say for this, the answer for this one is actually going to be 0 because it's going to be floor coverings can be 0 because it's a R&M deduction, and the answer is going to be 0. Okay, so for the next one, purchased goodwill. Number 6. During the year, they purchased a competing fitness centre in a nearby suburb. Heavenly Bodies paid $50,000 to the vendor for the goodwill of the acquired business. Goodwill is attested annually for impairment. The write-down for the income ended 30 June 2017 is $5,000. Okay, so what do we know about goodwill? It's not a depreciating asset. All right, logic will tell you that, because that would be an impairment expense, not a deduction in value. But let's actually just pull up our capital allowances just so we can prove this. So we need to know what kind of assets, intangibles, actually fall under this. So we know here, we know that goodwill and brand name is excluded for decline in value as it's not a depreciating asset, may give rise to capital gains loss on disposal. So section 40-30, not included as a capital asset. Goodwill not included as depreciating asset. Section 30-40. Did I pull that out right? 40-30, sorry. 40-30, the answer is going to be 0. And then finally, number 7, which is 50 times yoga mats. So they've purchased 50 yoga mats for $50 each for sale. their selling price for each mat is $80. So again, logic would tell you this isn't a depreciating asset. This would tell you it's trading stock, because this is something that they're purchasing for the purpose of going into business of selling these to members. Okay, so again, this is depreciating stock. It's trading stock, not depreciating asset. So now we can just calculate our totals, which is what the question wanted us to calculate. And there we have it. That's how you answer part A, question 2, to get a full 7 out of 7. So let's move on to part B, which is worth 13 marks now. So let's have a look at the question. Okay, so it's going to be an FBT question. For each of the benefits above, calculate the FBT taxable value for the FBT. Briefly explain any nil amounts. Okay, so it's an FBT question. FBT is always tricky. A lot of people have trouble with this topic. So the first thing I would do in an exam approach is actually go to the FBT chapter in our critical notes and just have that handy. Next thing I would do is actually just read through the question in detail and figure out what exactly, the question first, what exactly it is that we need to do to get the full 13 marks. So the question says, for each of the benefits above, calculate the FBT taxable value. Okay, so we need to work out the taxable value. After that, you apply your tax rate for the year, and that's going to calculate how much you actually have to pay in FBT. For part B, and there's 5 items above, so we're going to have a table of 5 items. Next, for part B, it says, for each of the benefits above, calculate the GST input tax credit for which G&T are entitled to claim. Okay, so we're going to calculate taxable value for FBT for each of the items above. We're going to calculate GST input tax credit for each of the items above. And for C, we have to explain the income tax consequences for the year ended 30 June 2017 for each of the above. And then for D, for benefits 3, 4, and 5, explain the income tax consequences to Johnny Hendricks, which is the other party. Okay, so probably the best way to approach this is, because they're all related to these 5 items, is to actually have a table and list your 5 items over here. And then in each of the columns, you can list your income tax impact, your FBT tax, your GST, whatever it is you need to do. So let's just have a quick look at the background. So we've got a resident private company, which is an alcohol distributor. During FBT year ended 31 March 2017, they provided the following benefits to its director and sole shareholder. So the first thing whenever you see an FBT question is to always check, does that FBT relationship exist? Because if that relationship doesn't exist, then no FBT is applicable. And there are many trick questions around this. So it must be a benefit provided by an employer or associate of an employer, provided to an employee or associate of an employee in respect of employment. So for example, if Johnny didn't actually work there, maybe he was a shareholder, but he didn't actually work there, FBT wouldn't necessarily be applicable, because you need all of those elements there. So the first thing is he actually an employee of the company? Well, it doesn't say here, but it does say it's its director. So what that tells me is that he's actually working in the company as a director. Okay, so now that we've done that high level check, and just keep that in mind before you do an FBT question, let's proceed to this. So let's set up our table as a next step. So in our tax workbook, this is part A. It's good to make your exam response as neat as possible, because if you could make your marker's life easier, it'll make it easier for them to give you the full marks for any question. Actually, what I might do is I might move it over here, because I think we're going to have fairly big table. Part B. Okay, so let's list out our 5 items first of all. So we've got private health insurance, airfares to the Northern Territory. I'm just going to write this in my workbook. So we've got 5 items. Okay, the first one is private health insurance. Then we've got airfares to NT, home internet, working from home. It's important to include the working from home because then you know it's actually part of their employment. Next is interest-free loan. And next one is G&T allowance to G&T distributors. Okay, now that I've done that, you can see what I've done over here. Now each of the questions actually asked us to set up or to let us know of the impact from a tax perspective of each of these items. So one perspective was the FBT taxable value. Let's bring up our exam paper over here. So we're going to do FBT taxable value as one thing. The next one that it's asking us to do is the GST input tax credit. So let's go GST ITC. The next one is income tax consequence. Okay, so this one's just for GH, or sorry, G&T. So we're going to go income tax consequence G&T, and then on the other hand, it's going to be income tax Johnny Hendricks. So I've got 4 columns currently. Let me just show you how I'm setting this up. I'm going to wrap these in Excel as well. Okay. Okay, so this is how we're going to set it up. Nice, neat response, makes it easier to get better marks. Okay, so now let's go through our different responses. Okay, so for the first one, private health insurance. Let's just go through line by line. Maybe we'll do FBT taxable value first for each of these. Quick recap of FBT, and of course you can watch our video of this down below. So a fringe benefit is basically, of course, the first check we need to do is to make sure that it satisfies all the definition of it, because if he's not an employee, then FBT doesn't apply. Now this question was a bit of a grey area because it just said director, and that could mean director employee, or it could mean director shareholder who's not an employee. We're giving it the benefit of the doubt and saying that he is an employee, but this question wasn't worded very well, to be honest. So basically FBT, it's basically any benefit provided to an employee, and it was basically implemented to prevent employees from avoiding tax payable by giving employees, assets and things like that instead of a salary, which would be taxed. So basically the government, to prevent people doing that, they applied the highest possible tax rate in Australia to any benefits provided. And now, it's something that companies don't really do, but it's meant to make companies pay people the legit ways. That's basically why we have this FBT. So the first thing to do is to consider, are there any general exemptions which may stop us? So, or does it fall outside of FBT? So all of these things fall outside of FBT. There are also some specific exemptions which apply to all of FBT. So, minor exemptions, work-related items, and so forth. So we need to go through this mental process of going, okay, does it fall into that category? Can it be exempt there? Can it be exempt there? So provided you've gone down all this way and it's still not exempt, the next thing to consider is what category of fringe benefit. Is it a car benefit? Is it a debt waiver benefit? Is it a loan fringe benefit? Is it an expense payment fringe benefit? Living away from home, meal entertainment, car parking, property, and so forth. What category it falls into. There's certain rules, there's exemptions and reductions. Depending on what category it is, you can't just apply one exemption or one deduction from one category against another category. You have to know what category it's in first. So private health insurance cover is going to be, it's either going to be an expense payment or it's going to be a property. People get confused between the two. Expense payment, let me just bring it up. Expense payment is basically when an employer pays for or reimburses expenses to an employee. So it's generally when, maybe this employee's paid for private health insurance cover. The company's then said, I'll reimburse you for that fee and pay it back to you. Whereas if it's the company's actually providing something themselves, like they might provide tickets or something, it's actually going to be, under property which is this one over here. So it's when the employer provides property, tangible or intangible, to an employee free or at a discount. So this could be intangible property as well, because in cover it's not a physical thing, but they're still providing it to an employer. So I like to think of it, if the employer is being reimbursed, it's an expense, but if the employer is giving it to them, then it's property. So in this case, we don't have a lot of background detail, but let's assume it's property. So exemptions could be reduced by otherwise deductible. So if this would be otherwise deductible, then you wouldn't have any FBT payable on it. So what we do know is it's calculated as the benefit, it's the dollar value of the benefit provided to the employee. So in this case, the question says $1,700. So we know that $1,700. Is this otherwise deductible or any of these other exemptions? The answer is probably no. It's not deductible. Everyone has to pay health insurance costs, and they haven't contributed anything to it, so there's no other deduction. So basically, the answer to this one is just going to be $1,700. So we're going to go $1,700. Now I'm going to go down the column, and I'm not going to go across, just because I want to stay on this taxable value, and then we can figure out what the income or the input tax credit implications are. So airfares to New Zealand, it really depends on the purpose. Is it a holiday or is it for work? Because if it was for work, then it's for otherwise deductible. We could reduce that by the amount, but it says here for a family holiday. So again, this is probably going to be property benefit. It's not otherwise deductible. We're going to put in a holiday in brackets in there. So we're going to put the amount of it, which is $2,200. Done. Okay, next one is home internet costs. Now it says here working from home. Now because he's actually working as part of his business deduction, we can actually say this would be otherwise deductible. So we can actually say we're going to reduce the whole amount by that. Now the only thing to watch out for is if they've actually said in the question, he's only using 50% working from home and 50% personal. It doesn't provide that here, so we're going to assume 100%. So we're going to reduce that by the full amount. So it's going to go down to 0. Okay, next one is loan. This one's a bit interesting because there's actually a specific category for this. Loan fringe benefits. So this is where an employer makes a loan to an employee, and the benefit is the amount times the notional interest. Okay, so the first thing to note, interest-free undocumented loan, not being repaid by 1 November, the date GNT lodged. So whenever you see wording like that, your brain should be thinking, that sounds like Division 7A language. The words not being repaid by the date of the company tax return, that's exactly what happens in Division 7A. That's the threshold as to whether Div 7A actually applies on a loan. If you're not sure what Div 7A is, watch the video on, what chapter is it in? Companies, I believe it is. Div 7A, yep, there it is. So, watch the video down below on companies if you're not sure what Division 7A is. So basically, that's the language. So that's a great technique when you're doing these exams, is to pick up on certain language that's used in other topics and go, okay, should I be thinking about this thing whilst I'm going through the question? Now, of course, Division 7A is only applicable for companies. We know it's a resident private company. So to me, that's kind of where this question is going. It's also a loan made to not repaid by one. Okay, so let's have a look at Division 7A now in the notes and FBT. So if we go to loan fringe benefit, we can see that it's when an employer makes a loan to an employee. The fringe benefit's the notional interest exceeding the actual interest, so the difference between the statutory rate and what's actually being applied on the loan. So if there's no interest, then it's just 5.37% times the total loan balance. We can see here that it's not subject to FBT if Division 7A already applies under Section 109ZB. Now, we just need to establish whether Division 7A has actually applied to the situation. So we've got interest-free loan. It looks like it's been provided to Johnny Hendricks, which is a director. So let's just do a quick checklist against company company Division 7A. And if Division 7A is applicable, then there's no FBT, and we can include a $0 taxable value. So basically, what would have happened if they haven't put the loan on a complying loan agreement, by the time the company's lodged its tax return, basically Division A is going to be applicable on this. And it looks like undocumented loans. So it says undocumented loans. So we know that there's no complying loan agreement. Therefore, Division 7A applies. There'll be a deemed dividend, and no FBT will be applicable here. If any of that didn't make sense, make sure you watch the company video, especially around Division 7A. So we can include $0 here because of, and it's a good idea to put a section reference in it on every answer you do. Even if I'm not mentioning it in a video, just make sure that you do have a section reference in there. So for this one, it's going to be, we said it was section 109ZB, I think, from memory. Okay, moving on. Allowance to G&T distributors. Okay, so the first question is FBT. Because it's with a different party, it's with suppliers, does the standard FBT relationship occur? So it's a benefit's being provided, yes, it's an allowance. Let's just confirm that salaries and allowance is actually a benefit. So it looks like excludes salaries and wages, exempt from being included in employees' income. So it's actually exempt from FBT. And also, that's not the only thing. It must be from an employer or an associate employer, from an employee to an associate employee in respect of employment. Now, if it's to suppliers, it's not actually in the course of employment, is it? To distributors, they're not an employee, they're a supplier. So for multiple reasons, no FBT would actually be applicable on this. It's not a FBT benefit, it's not an employee, it's not in the relationship of employment. So $0 for that one, and just put it in the relevant section reference for that as well. So let's move on to the next one, which is input tax credit. Input tax credit. Now, input tax credit is the value you get when you purchase something, and you get a credit back, the GST component. The general rule for FBT and GST is that an employer can claim GST input tax credit for all expense payments, fringe benefits, apart from those which are not deductible. Okay, so that's the first consideration under section 9-75. The second consideration, and of course we do actually adjust for something, whether they're entitled to an input tax credit, this will be the gross up rate, which is then applied to the FBT taxable value to calculate your FBT payable. So the next consideration is actually going to the GST chapter in our critical file and figuring out whether something actually has GST, or whether they're entitled to a GST input tax credit. So you need to go through all of these things. Have you made a supply? What is the consideration for your payment? Are you registered for GST, and so forth? Again, if you're not too familiar with GST, watch our GST video down below on the topic. So for the first consideration, have we made a supply? Was there consideration? Are you registered for GST? Was it supplied? Was it connected to Australia? Was it not a GST free nor input tax credit? So the answer to all of these up to the last one is yes. They've made a supply, which is the cover. Was there consideration? Yes, they paid for it. Are they registered for GST? We're going to assume they are. I'm not sure if it was mentioned in the question anywhere else, but we're going to assume they are. Was it made in the furtherance of the enterprise? Yes. Was it connected to Australia? Yes. So generally all of these ones are almost always yes. It's just really this one which, they may or may not be actually entitled to. So GST-free supplies are food, health, education, childcare, exports, supplies of going concerns, i.e. sales of businesses. In this case, health. This is a health insurance cover. So doctors, hospitals, doctors' fees, health insurance premiums under section 38-B is actually GST-free supply. So the answer for this one is actually no, right? Because it's a GST-free supply. So the answer is no ITC. In the exam, what I'd probably do is I'd probably have an explanation column under each of these. So I'm just verbally explaining the answers, but just to make sure that you get a full mark and make it as easy as possible for the marker, I'd actually put an explanation column in each of these. I'm not going to do it here, but just when you do your exam, just keep that in mind. I'm just doing it in an efficient way. Okay, so this one is 0 because it's GST free. put in your explanation GST free in a section reference as well. Okay, next one is airfares to Northern Territory. So basically the amount we're paying is $2,200. You know, we're going to go through the checklist for this, and it wasn't a otherwise deductible expense for FBT, so we would be entitled to it provided it's not GST free. Now I can't see GST free falling under this, and of course they're going to satisfy all of these checklists above. So the answer is yes, they get an input tax credit, so the answer would be equals 2,200 divided by 11. There's your input tax credit, $200. Okay, next one is the next one is home internet, working from home. What would be the GST input tax credit? Yes, for this one, employer can take input for expense payment fringes apart from those which are not deductible. This would actually be deductible because we use the otherwise deductible, so that's fine. So going back to GST, is there anything in here which makes it GST free supply, or anything above that it says no to on this screen checklist? The answer is no, it's all applicable and it's not GST free, so we can apply input tax credit for this one as well. So it's going to be how much? The $330 was the amount, divided by 11, there's our input tax credit. Okay, so for the next one is interest-free loan. So the actual supply is, you know, a loan, it's a financial supply. So for the answer for this one, the first one in the checklist, have you actually made a supply? This is another one to watch out for, because if we go down here and look at supplies, what constitute a supply? A financial supply includes most financial matters involving money, which is the case here. So we can see up here, input tax supplies which no GST liability, but the supplier can't claim input tax credits made in the making of input tax supply, so financial supplies. Section 40-5. So basically in this case, it's a financial supply, therefore no input tax credit can be claimed. So the answer to this one in the question would be no, because you know, it's a financial supply, so there's no input tax credit allowable. And then finally, allowance to G&T distributors. So let's go through the checklist up here. So have you made a supply? So, well, the answer is probably yes. Well, this one's questionable, but if we move on and just check the other ones, was there consideration? Well, not really. Are you registered for GST? Yes. Was it in the course of furthering an enterprise? Well, the employees weren't carrying on enterprise. So, you know, both S and E aren't really applicable here, so the answer is no. The answer is 0 to that one. Move on to the next part, which is actually talking about income tax consequences. Okay, so we need to figure out whether they can actually claim a deduction for these expenses. So for the first one is private health insurance. So if a company is paying costs for you as an employee, this would form part of your remuneration. And of course, employee remuneration, is that deductible under section 8-1? Well, the key criteria is it must be linked to the generation of income. Well, paying employee expenses is linked to your generation of income because you need employees to generate income. Therefore, under section 8-1, it would be an allowable deduction. So we can just say deductible. Section 8-1. Okay, next one is airfares to New Zealand. Well, this would be classified as entertainment cost, right? So entertainment cost, the rule for entertainment cost, and I can bring it up in the notes if you want, but I just know this off the top of my head, is basically you get a deduction if FBT has been paid on it. Entertainment, here we go. So it's not deductible unless it's provided as a fringe benefit, and fringe benefit has been paid on it, basically. So in this case, because we have actually included this as a taxable value in FBT, they're paying FBT tax on it, we can actually include it as a deduction. Section 32-30. Oh, -20. So the other thing we should probably be doing in this question is actually specifying the amount that's that's we can deduct. So for the first one, I'm actually just amend the answer so it's 1700. The reason is that there can be some confusion around whether we are deducting the GST inclusive amount or the GST exclusive amount. Now, if you're claiming an input tax credit, you can't claim a deduction for the input tax credit as well, otherwise it's double benefit. Whereas if you're an individual or something that's not registered for GST, you can actually claim the entire amount, including the GST credit, as the deduction. So that's why it's important to just specify either in words or put the dollar amount so they know which one's which. So for both of these ones, it's the GST exclusive amount, so the $2,200. Okay, same for this one. Similar reasoning to one. It's actually part of employee expenses, which would be remuneration deductible under Section 8-1. But of course, you don't be able to deduct the GST exclusive component, so it'll be $300. Okay, next one is interest-free loan. Now we said that this one was going to be a deemed dividend. And what do we know about deemed dividends? Let's look up companies and see if deemed dividends are actually deductible for the company. Okay, so consequences of Division 7A, not deductible to the company under Section 8-1. There we go, because it's a deemed dividend. Not deductible, Section 8-1. That was easy. And then finally, allowance to distributors. Allowances are deductible, same reasons as we talked about above. So the deduction amount that we can include here for them is $2,000. $2,000. Okay, so that's everything in here. Now, for the last question that we had to do, which was over here. Okay, for 3, 4, and 5, briefly explain the income tax consequences to Johnny Hendricks. So for 3, 4, and 5, it's only worth 2 marks. Income tax consequences. Alright, so let's find 3, 4, and 5, so we don't need to do those top 2. But we do need to know the income tax consequences for Johnny Hendricks. So Johnny Hendricks is the director. So we need to figure out from his personal tax return, how do we actually treat these amounts? Okay, so for the first one, home internet, working from home. So this internet cost, the internet cost here, the home internet costs incurred while working from home. From his perspective as an employee, it's actually going to fall under non-cash business benefits. I'm looking at Chapter 1 income. This is amounts less than or equal to $300, which is the case here because it's $300 of internet. Section 23L is actually non-assessable, non-exempt income. So we can include that in our answer. NANE, Section 23L, so $0. Okay, next one is interest-free loan. So we said deemed dividend. Of course, the company can be paying a dividend to the individual, which means that the individual also needs to record a dividend. So it's going to have a deemed dividend. We don't know the amount without actually calculating it, so we don't need to put that in. We can just put verbal description. The section reference for that we should be including. Here we go. Included in shareholders' assessable income is unfranked dividend. Section 20. Let's just include this whole spiel over here to get a full mark. And then finally, for this one, you're receiving an allowance to prepare entertainment or to incur entertainment costs for suppliers. So we know pretty standard one for him. If you're going to receive allowance income, that forms part of your assessable income. So that's going to be assessable under Section 6-5. Just like you would with any other part of your salary, like wages. Now the question is in terms of what about the expenses he incurs? If he's going to go out and actually, spend, so he can include his allowance as assessable income, that's fine. But his expenses, how does he actually treat that? Well, it's non-deductible because there's no FPT, similar for the company. non-deductible entertainment. Cool. That is how you answer question 2, including part A and part B, to get 20 out of 20. We'll move on to question 3 in the next video.